We are back to close out another crazy week in the markets. Crypto taking a bit of a hit. We got better than expected PPI data. The markets are getting a little bit too excited there. We'll be talking about all of that and more today on Money Never Sleeps. Thank you for joining us today, everybody. As we get going, you know the drill. Hit that like button. If this is your first time here, subscribe to our channel. Drop a comment if you want. Nothing that Kevin or I say is financial advice. So please do your own research for making any buys or sells. This is the year of doing less, Kevin. We saw bank earnings this morning. We saw producer price index data this morning. We're seeing crypto take a bit of a hit here. All the negative rhetoric out there. It's a really interesting time. Not sure who to believe at this point. At the end of the day, we believe the numbers, and the numbers are telling us a very interesting story.
Yeah, you know who we shouldn't believe? Anyone who takes the headlines from the BLS. But to start the show, I think we should start with this because yesterday, obviously, we got the initial jobless claims. This is something we look deeper into. There's a smart guy, Steve Van Meter. I follow him and I watch his YouTube channel. He brought up a really good point last night. I looked into the numbers as well. There is something funky about the way they're saying that there's jobless claims are, really went down about 1,000 or so. So I'm going to share my screen right now. We're going to take a look at the difference between seasonally adjusted and non-seasonally adjusted claims. And you guys are going to choose for yourself what to believe, because what I'm seeing is very different from what the current administration and everyone else in the news is presenting. So just looking at this right here, the initial claims, SA stands for seasonally adjusted, NSA stands for non-seasonally adjusted. So this is the number they were looking at yesterday. We were seeing that their change is only 1,000 in this row here, but that's for seasonally adjusted jobs. When we look at this for non-seasonally adjusted, as if, we're not accounting for stupid holidays and stuff like that to impact the number of jobs, you can see that there was 47,000 jobs that were added to jobless claims, to initial claims. So that means there's 47,000 jobs that are no longer there. People are looking for jobs, and the markets didn't react to that. They reacted to the seasonally adjusted number. Fucking hilarious, right? Let's go even down further to week ending down here. You can see the difference from December 23rd to December 30th. When we look back at this, you can see that initially it was a negative 34,000 people, I guess, found jobs. We look at this here, the change was actually 202,000 people had been added to the initial claims. So that's 200,000 people that do not have a job that are looking for a job. I am very when I see this, I just get so upset because people don't look at anything but the headline. And I was so happy when Steve Van Meter pointed this out last night on his YouTube video. This is something that's extremely dangerous because they're telling you that unemployment is at 3.7%. They're pretty much saying that the people here who are on initial claims aren't reporting to the government that they want to re-enter the workforce. Therefore, the unemployment number is going to stay low. And that's all people will react to. But let's put it this way. If there's that many people that are on initial claims now and that continues to rise along with continued claims, that means there's not as many jobs, people aren't able to get those jobs. You can be sure as hell that the market and the economy will absolutely tank at some point because the economy is slowing down and the labor market is telling you that right now. There's about 5 other indicators you can get through today that'll tell you the same exact thing, but this is one that they've been lying through their fucking dentures about. And I say dentures because we know who's been fucking cooking the books, fudging this shit around. But I am not happy by any means when I look at these numbers. This is absolutely bullshit. And everyone who says the labor market is strong is still stuck in a fucking vibe session.
Oh God, the vibe session. All right. So that's indicator one. Why don't we keep it moving in that direction? Give me the next indicator for why things are not as holly jolly as they may appear.
Shit, where do we want to go? You know what? The big thing today is the banks. Before we leave today, we have to talk about the yield curve because very interesting stuff there too. But let's talk about the banks because on that front, everyone is saying that JP Morgan, all these banks did extremely well given their earnings today. Let me just give you general overview. Earnings sucked. All right. There is misses, there is losses. Now there's talk of laying off 20,000 people in some of these banks. This is not what you want to see if, you want to expect that these banks are going to be making a comeback. I don't see it being a comeback. And there's two charts that we need to look at that'll tell us whether we're going to see a comeback or not. And one of them is the reverse repo. That's, again, the banks are looking for liquidity, right? We know that there's mass outflows from a lot of these banks. Deposits are leaving. And what we are currently seeing is that this red line is the actual number. They haven't adjusted this for today. This is a 3-day. Let me go back to the daily. You can see that we are currently sitting at about $603 billion of the reverse repo. That's where we're sitting at currently. This thing's been draining like crazy. And if you want perspective as to how it's been draining, there we go. Up here back in January of 2023, so about a year ago, it was at $2.55 trillion. This thing has been only down since. And the last time we were at this level, June of 21, when it was being added to, when there was more liquidity being added to the reverse repo. So what this tells me is that this is actually bleeding out a lot faster than we had anticipated. And the banks, again, I've said this before, the banks are not necessarily seeing pain in the market. A lot of their stock prices have been going up, if anything. When I see this here, this tells me that they are struggling, trying to find cash. And in fact, if this runs out before the bank term funding program, which we'll look at right now, we're sitting in a really, really weird place for markets come March, because this is pretty much a crisis at this point. We're seeing how much they're going after this. I mean, every week, every time we look back at the bank term funding program, this is the chart we're looking at, and it just keeps going higher and higher. This is exponential growth at this point with how little time we have left before this facility ends. We went up, it looks like 4.23%. We're up about $6 billion we added to the bank term funding program in the past week. Now, if the banks were really doing okay and Q4 was great and people are excited about the growth moving forward, this thing wouldn't be going up as fast as it is, and the reverse repo wouldn't be draining as hard as it is right now. And this is just a major sign that the biggest problem is just being swept under the rug. And if it continues to do this and we just don't see the natural organic deceleration of some of these equity prices, we're going to see a crash. We're going to see something very similar to COVID, right? This is a mania top. I'm not saying we're going to see a crash like COVID where it's 17 days which is down at 35%, but I'm saying that it's going to be unexpected and people are going to be like, how did this happen? Well, the number's been there for fucking a year, guys. It's been going up nonstop.
How did this happen? What happened? We're gonna
Right.
have a lot of fun voices that we're gonna make over over this next period of time.
I know, man. And again, here's the thing. I'm becoming less sympathetic towards the cause of, hey, I want everyone to be safe out there, to the point where it's like, no, the greedy motherfuckers are the ones that are in the market right now. This is absolutely mania top, and it's hedge funds, and it's people like that are in this market chasing it. It's why they buy every single dip. And the problem with that is they're betting pretty much other people's pensions. Like, that's the thing when you see a lot of these hedge funds, it's like, do we not remember what happened in 2008? A lot of them blew up. A lot of people lost over 50% of their retirement funds. We're not playing with small amounts of money. We're playing with derivatives, and derivatives are going to kill us all. And it's just not a safe place in the market to be seeing data like this come in and just everyone ignores it. You can't sweep it under the rug for a period of time. It's why volatility is being crushed like crazy. So let's just take a quick look at how some of these banks did. I'm pulling up Twitter because this guy did a wonderful job of putting everything in one place, unlike these banks who just put out all their earnings on 25 pages of paper, and it's impossible to read font 8 size, whatever shit that they are putting out. BlackRock's earnings, you see their revenue is 4.63 billion against estimated 4.63 billion, came in as expected. Their adjusted earnings per share came in a little bit higher than they anticipated. That's good. But their inflows is where it's really interesting. Their equity net inflows, 34 billion against an expected 39 billion. So that's a huge miss there. Look at institutional outflows, 16.07 billion against what they anticipated to be 9.78 trillion. Annualized, actually, it's 10 trillion against an estimated 9.78 trillion. So that's, again, came in hotter than expected. And the net inflows is absolutely insane too. 95 billion against 128 billion. So that's a big miss on their front too. And, given what's happening with the ETF mania, I wouldn't be surprised with how poorly it's, reacting this early, that BlackRock doesn't see some more pain moving forward in that regard too. JP Morgan, this was the one that everyone's saying was better than anticipated. Sure, the revenue came in a little bit shorter than they were anticipating. The estimated was about 40 billion, came in at 39.94. So just about a small miss, right? Their investment bank revenue 1.58 billion against 1.72 billion, which is huge miss. And then the estimated earnings per share 3.04 was the actual, and they anticipated those would be 3.57 for year over year. Huge miss on that as well. So you're seeing a lot of these go down significantly, right? Their loans are doing pretty well. It seems like a lot of the banks, Bank of America's loan department is doing okay, which is really surprising to me. But that could just be people necessarily need to borrow money in order to get out of maybe some other financial predicaments. Citibank, we're not really too worried about Wells Fargo. This was a crap one too. We can see that earnings per share 0.86 against 106, huge miss. Where are we? Yeah, that was pretty much the big one. They had some other bad numbers in there, but they don't have a good outlook for Q1 or Q2 of this year. They were saying Citibank is the bad one. This is the one that had revenue 17.48 billion against an estimated 18.68 billion. Total cost of credit, it's gone up. We're seeing total deposits 1.31 trillion. And the important thing here when it comes to Citi is this tweet right here, which is Citi sees net reduction in headcount over 20K. So it looks like they're going to be cutting 20,000 jobs. Again, Jane Fraser said that they were going to be doing that. It seems like they're going to be doing it now for sure, given how they lost 1.8 billion in the Q4. But none of this is good whatsoever. I don't know how we're spinning this as good. Any type of loss or downward move from year over year when we're expecting things to get better doesn't convince me at this point.
Okay. Very, very well said. I appreciate that one. Where to next? I don't know if we need to spend too much time on PPI. Came in under expected, but it's still, and we've seen the market react by sending probability of a rate cut in March up to 80%, of at least one rate cut by the March 20th meeting up to 80%. So, the market is looking for any reason it can to price in more rate cuts. And that to me is just like, and that at this point is like the least of the reasons why the market could take a big hit. Like if the expectations are not aligned with reality, like I don't think that's going to impact it as much as a lot of these other concerns with the banks, with consumer credit, with all of these other areas that are being downplayed. It's very much feels like a coordinated, and I don't want to get sound all paranoid and shit, but like it very much seems like a coordinated effort to make things seem a lot rosier than they really are.
It 100% is. I don't care. I'll fucking go out and say that. Those are my words, J-Web. I don't care at this point. The problem
I got your back. I got your back. So this is, Kevin and I are saying it right here. This is bullshit. This is a coordinated effort by the government, and we're going to get our show shut down soon enough, I'm sure, because they don't want the truth getting out there. And all 16 people who listen to our show, they will know the truth.
I mean, can I blame them at this point though? No, not at all, because it is really fucking bad, right? I mean, it's to the point where it's like, well, if people know how bad it is, well, then guess what? We're probably going to see a huge slowdown because people are anticipating that, okay, if it's going to get bad, let me not spend as much money. Let me save my money. That slows the economy down just as much. So I understand the reasoning for why these headlines make things seem better than they actually are. Now, the problem I have with a lot of the banking concerns too, just to finish this up, is banks are in a really bad place because they have a lot of losses because the rates are so high, and they need to get rid of some of those losses, and get out of them so that they're not held to maturity at a rate in which they're able to not get as screwed as they would be if rates were a lot lower. So they need these rates to come down. If the rates do not come down, and we're still talking about inflation and the Fed is still fighting this shit into June, September, even November of next year, the banks, it was an absolute fabricated crash against the banks, because we know that they're in such dire need for liquidity. They need to get out of some of these positions that they're still losing in. And we can tell that they're losing, obviously, from the earnings, but they're losing because they keep going straight back to the Federal Home Loan Banks. They're going back to the BTFP. They're going to the reverse repo for liquidity, right? Now, imagine when that liquidity runs out. That's the problem. And that's why I think that the rate cuts for March are a possibility if that becomes a big enough problem, or if banking globally becomes an issue. There's a lot of things that we could definitely see happening between now and March, or we could just see kind of like this Goldilocks zone of back and forth. But the rates are too high, and the banks are going to want those to come down significantly. Do I think we get down to 2% inflation? It really depends. I think we could settle for 3%, and the Fed could do that. I mean, maybe they don't want to, but if it's bad enough to the point where it's like, okay, we either risked everything collapsing right now, or maybe we sacrifice a bit of inflation. They're going to do everything they can to protect the US dollar. They're not going to give two shits about your equity prices or anything like that. So that's one thing that needs to be said. Moving into that, there's only one sector of the entire market that I'm seeing right now that is pricing in a recession or even giving any credence to the fact that we might see one, right? And that market is the most interesting market in the world, the bond market. And I promise you this gets a lot more interesting. We'll look at some fun charts in a second, but this
How
is the
can you
10 to
get any
2 year.
more interesting than bonds? I mean, it's already just as cool as it gets.
I know, man. Fucking 4% and all those, man. The problem is the bond market's going a lot lower, and by that I mean the yields are going a lot lower, and the bond values are probably going to go up significantly. And I want to point this out because I was looking at this a few days ago, and literally I was watching right before the show. Rebel Capitalist and Jeff Snyder were talking about this, and like, yep, I saw the same thing exactly what happened in October. October's inversion right here when we were getting really close to zero being reverted, that was because the long end of the yield curve, meaning the 10-year and onwards, or I mean even anything north of the 7-year at that point, was the yields were going extremely high. We're talking about, I don't even know where the yields were at that point. Maybe we were somewhere around, yeah, we were about north of 5% for the 10-year. But being that high, 2-year wasn't necessarily moving, but that was still enough to cause enough difference between the two where we were seeing this push up and we were getting close to reversion. Now everything's changed since then. Something happened in the banking system, and the global bond market's pricing that in now. But now we're seeing the front end of the yields start to collapse. I mean, if we look right here, the 2-year is down negative 2.52% in the yield today, and the 10-year is down negative 0.4. We are starting to see it naturally go towards what makes the most sense, but this is a bearish scenario when we see it go in this direction, right? The 2-year reverting with it being cheaper to borrow at that rate, and then obviously you get a better yield at the longer end of the curve, so it should be a higher yield percentage rate. That's the way it should be, but every time that happens after we invert, then once we revert, we probably see some type of economic hardship. That's because people are pricing in how the market is probably going to be played in the next year or two. So when I see this and we're seeing the 10-year kind of slow down here, I still think the 10-year's got a lot of room down. I think the entire bond market has a lot of room to the downside in terms of yields. But right now we're 2 years actually at negative 2.61. It's gone up since we were talking about it. There's a good chance that today, or I guess Tuesday's open or whatever the bond market opens next week, because we do have a holiday, there's a good chance that we are in probably either the low 20s or even in the teens, back to where we were maybe around October. And if that continues and we see that the yields are going down significantly and we're still getting a lot of bad news, and the bond market is the only one that's pricing in everything, and the equity market just absolutely going up still, we are talking about absolute catastrophe. I mean that from the bottom of my heart. I think that the bond market will have priced in either a recession or a financial crisis at that point, and everyone else that's caught up in the equity market is 100% going to be exit liquidity. And that's only if we do get to this reversion. I think it's happening a lot faster than we anticipated. If we look at this from where we were, off of Monday, December 18th of last year to where we are currently, we're up 46% in that short period of time. So we're getting closer and closer to breaking this back to above zero and the yield curve being in sync with a normal economy. But first, obviously, we need to see those yields crash, and that probably means that equities are going to crash too.
Okay. A lot of food for thought. Right.
No, sorry.
No, man, it's good. It's the information that we need to have and be aware of, because burying your head in the sand is not a good place to be when shit gets real. So what else do we want to look at as we close out the week? It's been a pretty boring day in the markets as far as TradFi goes. Everything's down a little bit. We see a few names leading the downward movement being Tesla and Coinbase. Coinbase down over 6%, Tesla almost 4% down. Anything in TradFi catch your eye? Anything in crypto that you think we need to discuss before we head out of here?
Absolutely. Let's just do Tesla and Coinbase real quick because these are a lot of fun. I texted you guys in the group chat. I'm like, sometimes we know what we're talking about. We said that if Tesla lost to 200 EMA, it's probably going to go a little bit deeper. It's going deeper, guys. I guess the news about Hertz and then just demand for EVs is really kind of starting to show in the stock price. I'm not saying that this is the bottom of it. I think we need to test a little bit lower, and then maybe greater financial circumstances might actually lead us out of this parallel channel that we continue trading in, that we've been trading in since December 2022. But I think our next trip is probably going to be around $200 to $194 a share if we don't get a bounce, right? If we do get a bounce, it's probably going to get rejected off the 200 EMA, which is roughly around 234, or the bottom of this parallel channel. But I think that the death cross is coming for Tesla. It's just a matter of time. We escaped it here. I don't think we're going to escape it a second time. And we just need to see, Tesla continue to bleed out. I don't think people anticipated it to be this bad, this quick. I mean, if we look at this on the weekly, we are roughly down, 4.42%, no, even more, 8.2% on this week. Week prior, negative 4.42, and the week prior to that, negative 1.61. So we've had some pretty bad weeks. 200 EMA right here sits at about $200, so that lines up with our 194 $200 price target. If we are able to find support on that, great. If not, then we're probably going a lot lower, maybe even to 164 150 range, but that's talking weeks ahead. You want to see us hold 200. If we're unable to hold that, then obviously we'll look at some of those price targets below there. But I would anticipate that we do see some type of bounce at some point. The question is, who wants to be the one to catch the falling knife and trade it? It might not be until we get to that weekly 200 EMA, since we've lost the 200 on the daily. So keep an eye on that. And Coinbase, this is one that's been so much fun for me because everyone I know that I love dearly has been telling me that Coinbase and Tesla and all these other stocks are going to go up nonstop. This ETF was the kiss of death for Coinbase. I don't care what anyone says. Is there a bounce here? Yes, I do think that there is a bounce for Coinbase at some point. If we look on the weekly, it doesn't look like we're going to get a bounce at any time soon. It looks like we have plenty of room to the downside. And I'm sure that once we get the Sunday open on the markets, or the Monday open on the markets when futures trading starts, pre-market, we'll see that this stochastic RSI is coming down significantly, but this one might be a little bit hotter than people expect because of all the things that are out there now. All these products, we got the ETFs, we got all these Bitcoin derivatives now, and we have Bitcoin itself, and they all track Bitcoin's price, right? And if Bitcoin is not doing too hot, there's a new sector in the TradFi market that is not going to be doing as hot either. And the best part about it is you don't even need to own Bitcoin in order to bet on the price of it now with TradFi. So we're definitely in a very dangerous state of play for a lot of these stocks. But looking at Coinbase on the daily, we're seeing if we hold at the 50 or the 50 EMA. The 200 EMA is sitting down here at around $98. That's kind of like our play. We expected that the wave 3 would probably end around there, bounce a little bit, and then we have a wave 5 coming down lower. And then we have to see where we are. If again, I think that we are in a 5-wave move to the downside. So that would be the first 5 waves here would be wave 1, then we get a small bounce, and then another 5 waves down, another 3 waves up, and then finish off with 5 waves. And then again, I keep saying this, but I think we'll be south of the low for Coinbase, probably south of $27 or so. And if that's the case, then there might be an opportunity for generational wealth buying Coinbase when it's down in the dumps, and hopefully Bitcoin's bottomed to that point. But we need to see Bitcoin bottom before we can even get bullish on Coinbase, in my opinion. And that time is just not right now. If we want to look at Bitcoin now and some of the ETFs, let's do it, because Bitcoin is having a wonderful day. Look at that, down 5.6%. Second day of trading live for the ETFs.
I mean,
Who's
we've
excited?
given up all. Bitcoin is now down on the week. So there is that. From where it peaked earlier in the week to now, it's about a 12% move. So that is pretty gnarly.
I mean, I'm here for it, man. It's been up only for the longest. And here's the thing. I'm still bullish on the fact that there's probably going to be a squeeze for Bitcoin here. And the reason I say that is because I don't believe this ETF was for institutions at all. If it was, the price would be a lot higher than what it is currently, right? It's not. I think a lot of this was priced in. It's selling a little bit here, but I do think that we need to see a distribution zone around that. Anywhere from 45 to 50,000. I think we'll start to see a lot of resistance once we get in those ranges, especially at the higher end of that, because we keep seeing Tether print. Tether printed another $1 billion this morning, which tells me that we're probably going to see the price push up. Is what it is. But I think more than anything, this price move to the upside is benefiting people like that were just overexposed, and it's not going to be helping anyone else other than them. I think they sold a bit at the bottom of FTX because they needed liquidity. They weren't sure if it was going to come back. And now they pretty much are in a place where they are in profit at this point, right? They're in profit greatly since the bottom of, June of 2023 or January 2023. Sorry, a lot of J's there. But when I look at this on the daily, sure, we're extremely overbought still. If we look at this on the monthly, that's going to be the key one. You can see that nothing's necessarily happened. All we have is this massive wick to the upside. I think that this wick is probably going to stay our level of resistance, 49, 50,000, being psychological. But there's a good chance that we are not done with this structure one bit. And if we look at the ETFs, we can see that they're going to be tracking this price all the way down. And they're doing a great job of it right now. Let me pull up the hourly, but you can see how the ETFs pretty much came out. Again, is it any different than any other IPO? Really high at the beginning, everyone's excited. Now they're tracking the price of Bitcoin, not doing a great job fully yet because obviously it's only been a few days, but for the most part, they're going to be tracking this extremely well. We've heard it from a lot of these people themselves, and that just tells me that people are going to be watching these ETFs bleed. The biggest concern I have with these is that Bitcoin's now going to trade in the after hours markets, and it's going to trade extremely heavily on the weekends because now that we have these TradFi instruments, it's easier to manipulate the prices from Friday close into Monday open now, where we're just going to see massive gaps and people are going to fucking be buying like crazy puts and some of these other instruments to absolutely just make tons of bank on the crypto market. So I do think that there's going to be a huge amount of manipulation that is coming in the way of this. And we're going to get our test run when Bitcoin starts pummeling down to corrective territory, whether that's 40% from between 34,000 and 30,000, or if we're talking 80%, which puts us sub FTX between like 14K and my favorite number in the world, 9,750. But when I look at this entire crypto market right now, everything's bleeding. Obviously, Bitcoin dominance is coming down significantly. I think Bitcoin dominance will resurge once again, especially if we get a stupid scam wick, but even more if the market starts to sell off and the alts are subject to that. We start seeing a lot of the alts sell off too. They haven't taken profits yet. I still think that there's one more push up for a lot of these altcoins. I still think those wave fives need to happen. Like Cardano here probably pushes north of 61 cents. XRP, I mean, it's probably going to push up one more time, stupid amount, probably maybe 65 or something like that. We probably will see like a stupid rally like that, like super crazy for a lot of these. And then after that, it's, it's down only most likely. Again, I'm looking at the 1 hour. That's why these charts all look all weird, but 5 waves to finish it. That's the way I see this corrective pattern. 5 waves to finish it. So once we get that in, all the technicals kind of line up for absolute chaos on the stochastics. That's the weekly. Let's look at the monthly. Yeah, I mean, we're pretty much in chaos territory at that point for the alts. So just give it time. I'm not necessarily scared one bit. I think everything is out there. Watch the funding rates to see how those play. Even if they look extremely heavy and long, I would anticipate that that's probably going to be a pump before a dump. They need to trap as many longs as they possibly can. And, come Tuesday morning, some of those ETFs are probably going to have some pretty nasty gaps to start the week. So I'm excited. I think we're in a good place, but again, we're not also in a good place because everything is lined up for absolute chaos without any type of organic trading to the downside, and that's a dangerous thing for all markets, regardless of crypto, ETFs, or TradFi.
All right. Once again, the year of doing less. Just do less, man. That is how we're going to wrap it up for this week. Appreciate everybody who joined us. If you have not yet, do us a favor. Hit that like button, subscribe to the channel, drop a comment, share us out on social. We'll be back next week to cover everything happening in the markets. In the meantime, have a great weekend. Stay warm out there, stay safe, and we will see you next week.
Take care, everyone.